But does today's action suggest that the Fed has broken the back of the bears? Guy, we were postulating just yesterday in sunny Miami that the Fed has nothing to gain by being dovish. What do we get today?
And it's interesting. I don't think they were particularly dovish. It's interpretation. And I need no help looking stupid. But when you see a reaction like we saw today, I mean, it just reemphasizes exactly that. I mean, I thought today when the market was down 400, I'm like, all right, they basically said what they needed to say. The markets accelerate to the downside. No. I mean, the reversal today was really interesting. And look, we have seen good semi numbers. Tim talked about it for a while. That's encouraging. Some of the data is encouraging in so much that it gives the Fed air cover. But I'll sit here at a 4,100 S&P and say we're now trading close to 19.5 times next year's numbers, assuming we hit those numbers, which I don't think is going to happen. So this market went from being reasonable to being expensive seemingly over the last week and a half.
It's almost like dovishness and hawkishness is in the eye of the beholder, because I heard things like, substantially more evidence that inflation was tamed. I heard things like, I just don't see cutting rates later this year. And yet we got this outcome. Michael, what do you think?
Yeah, I agree with you, Melissa. I found him to be extremely dovish. I mean, I was expecting... Dovish? Yeah. I mean, I was expecting him to come in, guns blazing, shooting down the loosening of financial conditions, saying, listen, markets, you've gotten way too ahead of yourselves. Inflation's still a problem, right? I mean, you saw the employment cost index, and yes, on a three-month run rate, Tim and I were talking about this earlier, you've come down a lot, but on a year-over-year basis, you're still north of 5%. The labor market's still hot. Look at the JOLTS data today. I don't think you can declare victory at this point. And although he said we're not, it sure seemed like he did just by the nature of the fact that he didn't come in and hammer the markets.
Well, he came in, and so let's parse every word, or let's actually go to the videotape, as Warner Wolf would say, and actually after. That's right, it really is. When the videotape was a special moment. You didn't get a lot of videotape. Now we have a lot of videotape in this world. But you have a case where at 2:35, so 5 minutes into the presser, you had the S&P down 1%. We know what happened. We had a 250 basis point intraday before at least almost a 2% reverse on the S&P, and we all know what the higher beta stuff did. But he started by pointing out that we are slowing the pace and that we actually are downshifting. But implied and even said in that is we still have a lot more to go. Now, this is a market that basically has the Fed priced in one more 25, and then we're done. It's a market that has the Fed pricing in 40 bips of cuts. It's actually now 35 or so. But again, then later on in the press conference, what were the keys that had the market take off? One was the financial conditions dynamic. He does not care as long as inflation is on a 2% path. And in fact, as the data has read, the divergence between the market and the Fed, he doesn't seem to care. Those are really important things. And again, at a time when the market often is right, and I'm going to probably say that the market is right, but I tell you, I don't think the Fed wants to go this year at all in terms of cutting rates. But the dialogue today from Powell said, either way, I'm more focused on the labor market right now. And then the labor market's something we have to worry about. Everything else is falling in line.
Yeah, so just to continue the sports analogy, you know how when you watch football, which I know you do often, and the half is over, and they get the coaches to say a couple words right before they go into the tunnel, and the coaches, team's ahead. You get that team coach, and he's like, yeah, we're very happy. The defense was good, but we got a whole second half, and so this is too early to call. So I actually didn't think he was as dovish as the market seemed to think. I thought that, to Tim's point, I don't see this easing.
No
at the end of the year. So I still think inflation needs to come in. So I don't know. I don't think it was. If you told me exactly what he was going to say and exactly what they did, I would not have said this would be the outcome of 300 or 400 point, jump from where the market was trading before that.
So, Karen, do you think we have a full half of football to play here?
I think we do. We've still got inflation.
Yeah.
And we haven't had China open, so that could be inflationary as well. So, the game is definitely not over.
Yeah, if the market's pricing in cuts for later this year, right, the bond market.
And it is.
That's not good for risk. This is what I'm not reconciling. How do you have a 19 times multiple with the bond market saying that growth is going to be so bad that the Fed's going to actually have to cut rates?
Because all equities see is lower yields equals higher risk.
That's right. They're not seeing the forest through the trees.
Right. Exactly.
Well, Carter Worth talks about this, and we have thought yields would go lower, and they're moving, at least in 10-year. And the inversion continues to sort of widen out right before our very eyes. It's gone from 49 basis points back to over 70 basis points. I think it's on its way to 1%, 3.25%, 4.25%, whatever it is. I think it's going there. But that's not bullish. And again, financial conditions aren't tighter; they're actually looser than they've been.
Right.
Which is crazy.
He was asked that during the press conference.
He was not earnest about that because financial conditions are clearly looser than they've been in quite some time.